2, 1. Okay, security swap. What is a security swap? How do we do it? When's it useful? When does some pre-planning really help take the stress out of changing properties, especially on your owner occupied? Wow, that was a mouthful. But a security swap is actually a non-credit critical change with a bank. What's that techie words mean is that if you want to sell a property and then buy a property without the need to have to go back to the bank for a new loan, a structural solution that some banks, mainly the majors or any bank that has a term deposit, offers you, well, not any bank that has a term deposit, but that's a feature of how to do it, works like this. You have a house with a mortgage on it. Let's just say the house is $1 million and the mortgage is $500,000. Now let's just say you want to buy another house for about $1 million and you only need a loan of about $500,000, what you already have. As opposed to having to go back to the bank for a new approval, what you can do is you can sell your existing house, take the money from that to keep the loan open. Okay, so $500,000, take $500,000, turn that existing mortgage into a term deposit and then put $500,000 in that term deposit, and then let the bank know that you want to use that term deposit to give to the bank as security instead of your house. So bank's loan stays open, it turns into a term deposit for a period of time. Then when you find the new house, you don't actually go back to the bank, you get the new property title deed, give that to the bank then gives you back the $500,000 you have in the term deposit, and then your mortgage starts over again. We can also hypothetically increase your loan amount from what it is. Let's just say you needed $800,000. We could increase the loan from $500,000 to $800,000 before you make that next purchase. And then you could do the same thing. When would it be useful to do that? If there were some major things coming up in your life and maybe your income wasn't going to be enough to service that loan in the future, or as has happened recently, borrowing power has gone down. So if you had geared up prior to borrowing power going down, you'd still have access to that higher amount. So security swap, what is it? It is simply selling your house, taking the cash from the sale to open up a term deposit to keep the loan open. Then when you buy a new house, it's going back to the bank to keep that loan, to restart that loan without having to go through the application process. The pros are that you don't need to go through the whole lending process and that stressful experience, because effectively you're guaranteed that amount of money from the bank as long as the new house you're buying is worth more than, as long as the amount you're going to owe the bank at the end is less than 80%. So call me to talk about it. That's the structure. Very useful. Does require some planning. Is a bit to get your head around, but in turbulent times can be a really strong way to make sure that you're as protected as can be when you're going through that property transition period.